So, first of all, thanks everyone for staying. On behalf of all those that overwent their time, I apologise on their behalf. Anyway, the other thing is, last 3 years we've all been locked away. I've spent that time thinking about how to communicate more effectively and differently with clients because we've all been to these blah, blah, blah presentations for too long. And so the stage is set. I was to do mine, been practicing interpretive dance. How to explain global real estate using interpretive dance. Unfortunately, on Sunday night, I did my hammy. So you're going to have to get stock standard presentation. So, global REITs. 30 years ago, going through some of the old press clippings, let's have a look at what people were worried about, because we always are worried about something, and everybody's always downplaying real estate. What were we worried about? We were worried about retail and shopping centres and the impacts of competition on retailers. We were worried about the future of office 30 years ago. What was the future of office? And we were worried about inflation. So it's remarkable that earlier there was a slide, the only constant is change, but I'd say the more things change, the more they stay the same. We're just constantly worried, and these themes keep popping up. What's ironic is, the thing that people worried about 30 years ago, inflation on real estate, was that inflation was falling, and they were worried about the impact of falling inflation on real estate because real estate was an inflation hedge. Fast forward 15, 20 years, the narrative becomes real estate's a yield play, rising interest rates is going to cool real estate. Now, of course, everybody's trying to talk it back into being an inflation hedge. Look, the reality is, real estate is a simple story, and that's the way I'm going to try and present it. It's supply and demand and finance. That's all you have to worry about. So what we've found is over a long period of time, as I say, people are nobody likes landlords. So it's very easy to dismiss real estate. Yet if we look at the hard numbers, it produces competitive returns. It produces a very competitive income yield. It does serve as an inflation hedge, and we have to talk about what that actually means. It's a liquid investment in the form of G-REITs. It is some of the world's best real estate in the listed market, and it's something that people don't fully appreciate. The G-REITs real estate platforms are the best quality real estate in the world in some of the most outstanding real estate markets in the world. And the listed REITs have been leaders in ESG. Now, clearly, the other thing we've got to worry about is time frame. I can't predict returns for the next 12 months. My predictive powers of picking Russia's invasion of Ukraine and the gas issues and COVID 3 years ago and the GFC, honestly, what's really going to be talking about in 12 months' time? Stick to the fundamentals, supply and demand, long-term investment, which is over 5 years. So, liquidity. It's something we've been used to the last 10 years, subsidised investment via QE and artificially low interest rates. It's going to be a tough decade for investors, we believe. Now, the reality is that what we've seen over the last 30 years is periods where real estate does seize up and there is illiquidity, and the pain and anxiety that causes for investors who are invested in direct real estate funds, unlisted real estate funds, when that occurs, the damage that brings is extraordinary. The listed REITs produce or provide liquidity. Now, you may not like the price at the time, but at least you can get your money out. You could also put your money in if it looks that depressed. But the reality is that in over 25 years of managing money invested in real estate, we've never suspended redemptions because it's listed. Now, drawdowns are an unfortunate part of the job. We'd prefer it didn't happen, but it's a fact of life. It is an opportunity quite often rather than a problem. What we believe is, if being listed is that bad, let's just close the stock market. Then all the volatility in the world goes away. It's a nonsense. It's a short-term issue, generally, and volatility is an outcome of liquidity. Ultimately, price and value will converge, given time. And that's why we think global real estate is a great surrogate for direct real estate. In the short term, it provides like an equity, but in the long term, it behaves more like direct real estate, the underlying investments that it holds. And what we can see is fantastic competitive returns over the long term. Now, 28 years, this is as far back as we can get data for the major benchmark, but you can see quite extraordinarily that global real estate, or G-REITs, have produced very competitive returns with other asset classes, and very favourably, a very high income component. So the line on the left is G-REITs, global equities and bonds, and as I say, very competitive returns. So let's break it down into shorter periods, because 28 years, point in time, maybe it's misleading. As I said earlier, we think 5 to 7 years is the right time frame, so let's settle on 6. What we can see, the blue line is the REITs, or is it teal? Are we allowed to call that colour anymore without a political connotation? The red line is global equities, and the light blue, I'm colourblind, is bonds. But you can see that REITs have actually produced, again, very competitive returns. There's been periods of underperformance and periods of outperformance. And if we look at that, break it down, where it has underperformed, very good reason. .com bubble, nobody wanted to know about REITs. You turn up at a conference and it was literally get off, all we want to hear about is the next .com, how many hits they were getting, etc. And then more recently, REITs have been underperforming because obviously COVID has had a very dramatic impact on the use of real estate as people have been locked away. There's been corporate tax cuts, which have been boosting the corporate earnings. REITs aren't taxed, so therefore they didn't get the benefit of lower tax rates. And of course, share buybacks have been boosting earnings for corporates. So REITs have been underperforming through this period, but we've had periods where there's been significant outperformance, such as in here, which was largely as a consequence of investors realising that they'd oversold REITs in the .com era, and then there was a whole lot of M&A activity, and quite frankly, there was some pretty irresponsible capital management that led to the likes of the Centro blow-up, etc. But generally speaking, again, very competitive returns with a number of those other very attractive attributes. And one of those great attributes is that income is a more significant component of the total return, as you can see, consistently better than fixed interest and equities. Now, one of the compelling things also is that the earnings are far more stable than equities, which gives investors a lot more confidence about the reliability of the income streams. Now, of course, we've all heard the narrative changing, as I said earlier, from being a yield play to an inflation hedge. When I started my career, real estate was an inflation hedge. When inflation evaporated in the 90s, the narrative changed, and now it's changing back. Look, the reality, as I said earlier, is real estate's a supply and demand game. If you've got favourable supply and demand dynamics, you can push rents. And that's why it's an inflation hedge, particularly if you have a situation where construction costs are rising, as is the case today. What happens is, if I'm a developer and I've got a piece of land, I build a building, I'm then going to compete against an existing landlord who has an existing building next door, and I poach the tenants, and so therefore it's a battle to attract tenants. If your construction costs are going up, the developer has to get a higher rent. So as a consequence, they're less competitive with the existing building owner whose cost is historic, whereas today's developer requires a higher rent to justify building, and therefore, again, that means there is an underpinning of rents. So rents should grow because there'll either be no supply, or if there is supply, the rents needed will be higher. So again, what you have to have is the right fundamentals, though, that landlords have pricing power. And fortunately today, we do have that sort of supportive dynamic. So what we have is a picture of very high occupancy. So again, typically portfolios are less than 5% vacant. Now, it's a rule of thumb that if you have less than 5% vacancy, in fact in the US it's less than 7%, it's a landlord's market. Vacancy is more than 7%, it's a tenant's market. So as you can see, we're actually looking at quite a positive picture. Now, but we need to have economic growth though. Now, and limited supply. So what we can see back to 1970, we had an absolute building boom in the 1970s, 1980s, which led to an oversupply that led to the property crash that we saw in the 1990s in Australia, which incidentally, if it was referred to earlier, Westpac was broke in 1992-93. Make no bones about it, it was bankrupt. I worked for a broker that did the emergency capital raising. Of course, they didn't highlight it because it was one of the major institutions. They were bankrupt. And that was because they lent huge amounts of money for new construction of buildings that weren't necessary. Now, the GFC, what was the GFC about? The GFC was about overbuilding of residential property. Huge amounts of construction activity that wasn't needed, that led to the subprime crisis, overbuilding and the property crash. But what we can see today is that construction activity is actually quite modest. So we've got high occupancy and modest supply, which means that the real estate market is actually in very good shape to go into this downturn, or these more challenging conditions, I should say, at the least. But as I said earlier, real estate is about supply and demand and about finance. Location, location, leverage. Right? At the end of the day, great real estate will go through downturns. It is a cyclical business. You've got to make sure that when you go through the downturn, even good real estate, you don't want to be in a position of having too much debt where you're forced to sell the assets or raise equity at deeply discounted prices, which impairs investors' capital. And that's what we at Resolution Capital spend a lot of time looking at, making sure that the real estate's great and that the balance sheets are strong. That means that the REITs are actually able to take advantage of weakness in the market, not being forced to sell the assets. And what we can see is that, again, the REITs are actually in pretty good shape by and large. Now, there's always exceptions, but the US REITs, we can see leverage. They have been deleveraging for the last 10, 15 years since the GFC. The worrying case is continental Europe. They've been sucked in by negative interest rates, right? They were literally being paid to borrow money. And sure enough, they leveraged up, and now they find themselves in a very vulnerable position given the geopolitical issues and rising costs in Europe. For Australia, by the way, the A-REITs, their biggest challenge is that they've got a lot of floating rate debt. Most of the European and the US REITs have long-term, and I mean average 7 years, fixed rate debt. Australian REITs have 3 to 5 year debt, 40% unhedged. So in other words, rising interest rates is going to impact short-term earnings for the REITs, for the A-REITs. And what we can see today is that globally, the REITs are in pretty good shape relative to NAV. In fact, they're trading at a pretty good discount to the direct market. So one of two things is going to happen. Direct real estate values are going to fall, and we think there's probably a good chance of that, perhaps 10, 15%. And or REITs are going to be taken over because they are at a discount to the direct market. So the likes of KKR, Brookfield, Blackstone, private equity players, sitting on a lot of dry powder, they will be looking to take advantage of the quality of the real estate owned by the REITs by taking the REITs private. So how are we playing it? The simple theme to take away: beds, meds and sheds. So basically, beds being accommodation, residential, rents in the US are growing at 10% plus. We're seeing a similar dynamic here in Australia. There is a shortage of residential in many markets around the world, leading to this affordability issue. Meds being healthcare, the ageing population. We're able to buy very attractive senior housing platforms in the US, which is needs-based, where occupancies are filling and there's limited supply taking place. And then on the sheds, we're talking about logistics, self-storage, which everybody obviously knows about the logistics story in terms of e-commerce and digitisation. I won't spend any time on this. Unfortunately, there are some great stories in REITs that people don't appreciate the quality of the platforms and the real estate they own. Federal is a poster child of improving the value of the underlying land through mixed-use development, making them a place that tenants want to be. So you start off with retail, you add residential, you add hotel, you add office. It becomes a highly desirable mixed-use location where they tilt the portfolio to where the tenant demand is. Again, REITs are in great shape in relation to sustainability. For us, it's about competitiveness, and therefore what we're finding is the REITs are actually leaders in the pack in terms of providing the most sustainable, the most efficient buildings, which means they're the most competitive. So that's it in a nutshell. It's a simple story. If I'm here telling you that the supply outlook is frightening, if there's high vacancy, I'd be wasting your time. No pricing power, you don't need to invest. The reality is the REITs, though, over the long term, provide competitive returns, and the fundamentals today are pretty reasonable. So thank you for your time.